Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. I think that health savings accounts, also known as HSAs, are one of the most misunderstood, but also one of the biggest opportunities that people have in personal finance. So I've been anxious and excited to devote an episode to that topic today. And we have a guest who's really devoted his time to getting the word out when it comes to HSAs. Bill Stuart has been working with health savings accounts since they were introduced back in 2004. So we're celebrating the 20th anniversary this year. He has served as the chair of the American Bankers Association HSA Council's Compliance Committee, and he's written 2 books specifically on HSAs. You can follow him on LinkedIn. We'll make sure to have links to resources and show notes, and read his HSA Monday Mythbuster, HSA Wednesday Wisdom column, and HSA Question of the Week column. Hey, Bill, welcome to the podcast.
Thanks, Melissa. Look forward to a conversation.
I know that HSAs are later to the game. Many of us were familiar with either cafeteria plans or FSAs, flexible spending accounts, that had to do with our reimbursing us for our medical costs. So, let's roll back. Say it's 2003, and I'm going to explain what this HSA is that's coming. Or for somebody who just has no idea, they've seen it in their benefit options, or maybe they don't have it as an option. What is a health savings account?
Yeah, so you mentioned cafeteria plan and health FSAs, and health savings accounts are a lot like FSAs in terms of immediate tax benefits, but they're so much more powerful. Think of them sort of as the child of an IRA and a health FSA. So these are individually owned accounts that allow you to put aside money on a pre-tax basis. So you make pre-tax payroll deductions. Your employer can put money into them. The money goes into the account, pre-tax or tax-free. It grows tax-free. It comes out tax-free when it's used for qualified medical expenses. So it's really the only vehicle that the average American has that experiences no tax friction whatsoever. As long as you use it for medical expenses, then money goes in tax-free, grows tax-free, comes out tax-free. That's the beauty of it and the simplicity. So at a very high level, that's what a health savings account is. Now, you can have one only if you are enrolled in what the IRS calls qualified high deductible health plan. Nobody in the marketing industry would ever call anything a high deductible health plan. We call it an HSA qualified plan. Essentially, the plan has to have a deductible of at least $1,600 if you cover only yourself, or $3,200 if you cover at least one other family member. And all services have to go toward that deductible. So the average employee today, particularly in small groups, has deductibles higher than that. And HSA qualified plan deductibles are often higher, but the point is it's a fairly mainstream medical plan at this point. So have that medical plan, don't have any disqualifying coverage, and you can take advantage of this wonderful financial account called the health savings account.
Well, that's worth noting. First, you need to be sure that what you're enrolling in does qualify as that qualified high deductible health plan. And oftentimes they're paired if it's kind of a benefit setup. And in some cases, you may have a lower deductible option where you don't have that HSA option, and it could be even advertised as the HSA plan. And in some cases, I do ask clients to ask their HR or ask their insurance agent, hey, is this a high deductible option, just to double check and make sure, because that is one pre-qualification before you can make this contribution.
That's right. And what gets confusing is you could have a plan that has a $2,000 individual deductible, and you'd say, oh my gosh, that's an HSA qualified plan, but it covers certain services outside the deductible. It charges a $25 copay for an office visit or $10 copay for a generic drug. That plan is not HSA qualified. It's not just the level of the deductible, but it's the fact that all non-preventive services have to go toward that deductible. So early in the plan year, you're always paying the contracted rate rather than a copay for services. And as you mentioned, when an employer is offering this, the broker, the employer know it's an HSA qualified plan. That's typically not a problem. It gets a little bit dicier for people who are buying in the non-group market to make sure that that plan, just because it says $2,000 deductible, really is an HSA qualified plan.
Okay, so now let's fast forward and assume that yes, you're still in the game. You've determined that you have an eligible plan. Now the HSA contribution is separate from the plan itself, correct?
That's right. So you are paying a portion of your premium for the medical plan. And then on top of that, you now have this financial account that's independent of the medical plan. It's a personal financial account, but now you have the opportunity to do pre-tax payroll deductions to put money into that account as well.
It's interesting. So both you and in some cases your employer too, if it's an employer-sponsored plan, may be able to contribute or have that option, correct?
That's right. So what we find in the industry is about 2/3 of employers do contribute to an HSA in some form. And the average among those who do is about $900 for individual coverage and about $1,800 for family coverage. So employers are generally putting money in, not always. Some employers will do it for a few years, and then as employees build their balances, the employer ratchets back its contributions. And in some cases, an employer really has no financial option other than offering a HSA qualified plan with its lower premium and says to the employees, I can help you with coverage with the insurance premiums, but I just can't help you with the deductible. You're on your own. And one of the best ways to fund an HSA, as you mentioned, very often employers will offer more than one plan. Boy, if you just take the difference in premium between that lower deductible plan, which is going to have a much higher payroll deduction, and the HSA qualified plan, that may well be $20, $30, $40 per pay period. Just stick that into the HSA. Your paycheck, net paycheck won't go down, but you'll be putting money into the HSA systematically that otherwise, if you enrolled in the other plan, you'd just be giving to the insurance company.
Interesting. I like that. Sometimes a little mental accounting is really helpful, and you're also helping on your taxes in that case.
Yeah, and I think it's really important, Melissa, because so often people say, they look at the list of the 2 or 3 plans the employer offers, and they say, oh, this is the best plan. It is only a $500 deductible. Well, yeah, that's less than the $2,000 deductible, but if you're paying $1,500 more in payroll deductions for the premium on that, then it's the same. It's the same, and you've lost that $1,500 is going to the insurer, whether you have expenses or not. If you choose the higher deductible plan and put that $1,500 in your HSA, if you have a bad year, you're giving it right back to providers. If you have a good year, a low claim year, then you're keeping that money. The insurance company isn't. That's your money to spend on future expenses.
Well, let's get into that spending category now. So for many people, and this is just going to have to be a necessity, the HSA is really a current wallet because they may or may not have emergency reserves on hand, or by habit, whenever they have these types of accounts, the first thing they do is, kind of hook up the debit card. So when they drive through the pharmacy at CVS, they're getting money back into the bank account, or they're using that debit card and the money's coming right out of the account. So that I want to cover before we talk about, longer term uses of the HSA. How does it work? What are you eligible to use funds within the HSA for?
If you're familiar with a health FSA, it is the same list. So it includes all your cost sharing on your medical plan, your dental cost sharing, your vision cost sharing, over-the-counter drugs, medicine, equipment, and supplies. All of those services, any part of the bill that you owe is a qualified expense. And it also includes things that aren't covered by the medical plan. Not all medical plans cover acupuncture, but I've had acupuncture before, and it was great for relieving what I needed. I could pay for that out of my health savings account with pre-tax dollars. So we're not limited to what the medical plan covers. In addition, with a health savings account, it can help you in several occasions when you may be a little short of money in your life, in helping you with premiums. One of those times is when you are between jobs. If you are collecting unemployment insurance or you are continuing coverage through COBRA, you can pay your medical premiums with HSA dollars, tax-free. And then in retirement, when you're enrolled in Medicare, Medicare has premiums, and you can reimburse the Medicare premiums directly out of your HSA on a pre-tax basis. So it helps not only with those qualified medical expenses, but also pulls in the insurance sometimes when you need that money the most.
So we're saying you can't always pay for your insurance premiums with the HSA plans, but in some cases you can.
That's right. It's just limited to that unemployment or COBRA. So one of the questions that always comes up is, what happens if I retire at age 60 and Medicare won't let me in until age 65? What do I do? Well, if you have the option of COBRA for 18 months, there's 18 months worth of premiums you can pay out of your HSA. But then to bridge the gap between there and age 65, if you don't have a spouse or other plan to jump on and you buy a plan in the non-group market, those premiums are not a qualified expense. You can't take money out of the HSA for those premiums. If you do, it's included in your taxable income and you pay a 20% penalty. So you lose about half the value of everything you take out of the HSA if you're using it for non-qualified expenses.
Got it. So let's talk about timing too. So if you're familiar with the FSA world, it's like used to be, 12/31 is the deadline. Now there's a little bit of a grace period, but it's fleeting. It's use it or lose it, basically. In the HSA world, that's different. Is that right? It
is totally different. There are a couple of key features here. Number one, there is no plan year with an HSA. What you've described, the health FSA, is absolutely right. You have 12 months to spend your balance, your election. Your employer may give you a little more time, either with a grace period or allow you to carry over a small balance into the next year. But essentially, you've got to spend that money and you've got to file for claims promptly. With an HSA, it's a permanent lifetime account. It's like your checking account. It doesn't go back to zero at the January 1st. The money's always there. It accumulates over time, and you never face a deadline to reimburse expenses, which I think is really cool. I mean, I've had an HSA since 2009, and I'm a saver. I want to keep that money in there growing tax-free to help me pay medical expenses in retirement. And I'm fortunate that in a lot of cases, I can pay for expenses out of my personal funds, after-tax funds, and leave money in the HSA. But I also keep my receipts. So every year at the end of the year, I have a summary from my insurer of how much of my deductible I've met. I've got some explanations of benefits. I've got dental bills. They're all thrown in a 3-ring binder in those plastic page protectors. If I suddenly needed $20,000 today, I could take that out of my HSA and report that as a qualified distribution, even though I'm paying for a new car with it, because I accumulated qualified expenses and I have the receipts to show. I could have reimbursed these things between 2009 and today, but I didn't. I'm just simply deferring reimbursement of my son's braces in 2012 and my wife's contact lenses in 2014. So you never lose the opportunity to reimburse. No one ever says to you, you missed the deadline. Sorry, you forfeit your money.
Well, that's interesting. I'm thinking about those early retirees, by the way, where like once you run out of COBRA, then you're on and perhaps a plan from the exchange or something like that. Then you couldn't be reimbursed directly for your healthcare premiums, but you could say, I've been waiting to use these receipts in this particular year. So that could be a great gap.
That's right. And the other thing that you can do in that scenario is you could buy a low premium plan on the exchange. Let's say you buy a plan with a $5,000 individual deductible, knowing that if you have a bad year and incur those expenses, that money can still come out of your HSA to pay your deductible expenses. So we've identified a couple of different ways of working around that little, bridging that gap between early retirement and Medicare.
Well, I'm loving that optionality. And we're kind of sneaking into the part of the conversation that really gets geeks like us excited, because the HSA is not just a wallet. It can also be used as an investment account, as an additional retirement account, hopefully in many cases for your medical expenses. Tell me a little bit about, well, first of all, a lot of people don't know that. They really, keep it in cash, and it's like, just waiting for the next reimbursement. But tell me the difference.
Yeah, so most of the leading trustees of health savings accounts in the country, and you know the names, Fidelity and HSA Bank and Health Equity and Optum and Bank of America and WEX, they are offering a suite of investments. And the option could be anywhere from a hand-picked list of 2 dozen to 4 dozen mutual funds, or it could be a full investment platform. So it varies by trustee. Some of them want to give you a smaller menu because they fear that paralysis by analysis, that somebody will be so overwhelmed seeing they can buy 8,000 different stocks that they'll do nothing. So here are some mutual funds. And if you are a conservative investor, here's the direction you should go. For others like me who want to play the market a little bit more, the idea of having a full brokerage account and an HSA is really exciting. So in most cases, you're going to have to keep a certain threshold of cash. They're going to ask you, the trustee is going to say, you need to keep $1,000 or $2,000 worth of cash. That way, you always have money on hand to pay an unexpected bill without having to worry about liquidating investments while the market is down. So you will have to keep $1,000 or $2,000 in cash. Other than that, you're free to invest as much of your balance after that as you want. Now, as you mentioned, not many people take advantage of it. Probably, I think it's 10% or so of accounts, 37 million accounts, by the way. So about 3.5 to 4 million actually have balances invested. The rest are 100% cash. The problem with cash is, well, it's great if you're using your health savings account like a health FSA, and the money comes in and the money goes out just as quickly. But if you're saving long term and inflation, forget the last couple of years, but inflation is 2 or 3% a year in the general economy.
And it's higher for healthcare costs. Yeah.
Medical is typically twice that. So if medical expenses are going up 5% a year in a normal span, and the interest you're getting is 1/10 of 1% or 2/10 of 1% on your cash, you're actually losing serious buying power every year, just as you would in a retirement account. If you're at age 25, you've got all your money in cash. You're not going to get ahead that way. You'll feel safe because you'll never lose, but you'll never really gain. So with an HSA, it's a matter of determining just like a retirement account, your time horizon, your level of risk, but put that money to work. You know that the stock market as a whole over the last 100 years has returned about 9% a year. That's including depressions and upticks and downticks and pandemics and dot-com bubbles and everything else. So put the money into something where it's going to grow to at least keep pace with medical inflation.
Yes, past performance doesn't predict future returns, but there's certainly, when you're thinking about this asset long term, I'd also mention this account to your financial planner if you're working with someone like me, because so many times I find we get through all the list of accounts and then they're like, oh yeah, there's an HSA. Well, there may be a misidentification of that investment option, but these are often clients that do have, high income. They have the options. This would be perfect. There's a lot of money piling up in the bank, and then they're ending up spending this HSA account. I can even speak for personally. My husband carries the insurance for our family as a small business owner, And then he signed up for a new HSA plan where they were just automatically reimbursing him as he went. And I opened the account statement 9 months into the year and was like, whoa, whoa, whoa. No, we don't want to spend it now. We'd rather invest it for later. That kind of gets into the area. Sometimes your employer dictates, but how do you research HSAs if you do have a choice and you're kind of self-directing?
Yeah, so you make a very good point that most people get their HSAs through their employer, and their employer is going to choose one trustee to administer. So you're going to get XYZ HSA, and that's the only one your employer is going to deal with. You still have the option of opening a second one on your own and moving money from one to the other. It's not a complicated process, so you can do that. But also, as you mentioned, if you're buying in the non-group market or your employer says, I'm not sponsoring anybody, go out and find your own, or you leave a job and you have an HSA with that employer and it's $4 a month maintenance fee and you don't want to pay that, so you want to go out and see what there is. It's as simple as doing an online search. You will get so much information. You'll get rankings of which one's the best for spenders, which one's the best for savers. The key point to really understand is that there are differences among them, just as there are differences among checking accounts. The most important thing is to have an HSA and be funding it. That's 90% of the battle. The other 10% is which one's going to pay a little more interest, which one has a little bit lower fee, if any, which one has a little bit lower threshold for investing, which one has more investment options. But the big benefit of this is the immediate tax savings. And then secondarily is how you can build the value of your balance over time. The tax savings is going to be the same no matter which one you choose. So when it comes time to really start building your balances, growth for the future, then start looking at whether this account or that account is going to get you there faster.
That's so true. And if I can just editorialize for a moment, I know why this is, but the beauty is the big rock, that tax savings and that investment option. We call it a triple tax-free play when we're in the financial planner world. It is sometimes frustrating in those HSA accounts. They're small. They're necessarily often small accounts, which for banks are probably a major pain in the butt to administer. And so there are a lot of here and there fees that can be frustrating or annoying. That is not my favorite part of the HSA game, is HSA administration. So do be wary of those low balance fees or the quarterly statement fees and things like that. Kind of tune into the statements and see what's going on.
Yeah, and usually even that there are more and more HSAs that don't impose fees. The ones that do, a lot of times you can avoid them. You know, it's $2.50 a month, but that's waived if you have a balance of $2,000 or more. Okay, if you have a balance, you waive that. You mentioned the quarterly statement. You know, they may charge $2.50 to do a quarterly statement, but they'll usually give you the option of checking a box and getting that electronically. There, you've saved the money. So really the only time you should be paying fees is you may pay a small fee for the investment platform, or it's like a checking account. If you have an overdraft, you overspend the account, you could get whacked with a fee. But if you're using it right, the industry is so competitive now, and there's such compression of fees that it's easier and easier to either get a no-fee account or to easily avoid those fees. But they could be there. Make sure you understand them before you put the money into the account.
Well, I love that increased usability. Well, we will, in resources, provide you with some reputable lists of kind of, here are some of the details on some of the bigger players in HSAs. How much money can you put into an HSA?
The IRS has a limit every year, and it's adjusted for inflation.
Okay.
So in 2024, if you covered only yourself, it's a one-person contract, you can put in $4,150. If you're on a family plan, it's $8,300. And then in addition to that, anybody who's age 55 or older can put in an extra $1,000 a year. So in my family, my wife is actually the one who carries the insurance now. I always did it. She does it now. So she puts in $8,300 for our family contribution. She puts in an extra $1,000 as her catch-up contribution because she's over age 55 or older. And I put $1,000 into my own HSA because I'm 55 or older. So $10,300 tax savings, our reduction in taxable income, which for us translates to about $3,000 or so of actual tax savings in a given year because we're fully funding our HSAs. Now, not everybody can do that, obviously, but every dollar you put in is going to reduce your taxable income by $1. So whether it's $1,000 or $4,000 or $8,000, you're getting that tax benefit right up front.
And is that reduced by the amount that your employer puts in? So if the employer puts in
Yes.
1,000, is it?
Yeah, the contribution limits are from all sources. So if your employer puts in $1,000, your aunt gives you $100 for your birthday and writes out the check to your HSA, that can go into your HSA, but it's all sources combined. It can't be more than that $4,150 or $8,300. By the way, in 2025, those figures go up from $4,150 to $4,250, and for a family from $8,300 to $8,550. So they're adjusted every year for inflation. That adjustment figure comes out early in May, so we already know what the figures are going to be for 2025. Unfortunately, the $1,000 catch-up contribution is not indexed for inflation, so it remains at the same level it did in 2004. $1,000 just buys a whole lot less today than it did then.
Well, I did not know until this year, it probably was one of your LinkedIn posts, that you can do that $1,000 for each of the family members. And I'm going to be turning 50 next year, even though Jeff, who will be under 50, will be in the HSA plan. So I could do my own Melissa's HSA $1,000 start, right?
Got to be 55.
Oh, 55.
55.
There I go. Thank you.
So age 50, you can start making your catch-up
for the
contribution
retirement.
to your retirement plan, but you got to wait another 5 years for your HSA.
Thank you, Bill. So any other, you're a myth buster, but any other kind of secrets, cool parts, or things we didn't cover that we need to make sure people know? There is so much I know.
I know there is a ton. I do want to make a couple of caveats here. There is disqualifying coverage we have to be careful of. So to open and fund an HSA, you have to have an HSA qualified plan. We already talked about that. You can't be somebody else's tax dependent, which simply means that, you got a 14-year-old kid who starts earning babysitting money. You can open a Roth IRA for the kid. You can't open an HSA because he or she is still your tax dependent. And the third thing is you can't have any disqualifying coverage. The big villains here are, number one, Medicare.
Yes.
So once you enroll in Medicare, you're no longer HSA eligible. Now, I am age 66, I hate to admit. So I am eligible for Medicare at age 65, but I haven't enrolled yet. So I'm okay. I can still contribute. But once I enroll in Medicare, I will not be able to put any more money into my HSA. The other thing that can trip people up is a general health FSA. We're all familiar with them. It's not unusual for a family to have two of them. Both spouses work and they've got a kid who's got braces that year. You can double up on that. A general health FSA looks in the tax code like a medical plan that pays first dollar reimbursement for medical expenses. So that would be disqualifying. And it's not only you, the subscriber to the medical plan, but your spouse's health FSA automatically covers you under federal tax law, even if you didn't know that, even if your spouse doesn't have a medical plan at work. So you've got to be very careful about that. A general health FSA is disqualifying, but there is something called a limited purpose FSA that reimburses dental and vision only. You can have that and be HSA eligible. So those are the things you just have to be careful of. It's unfortunate that with that FSA thing, now your health benefits become pillow talk among spouses. They've got to make sure that one of them doesn't do something at work that disqualifies the other one from funding an HSA for the family's medical expenses.
Well, the HSA is certainly high on opportunity, but also a high degree of difficulty. So I'm so glad that people like you, Bill, are out there to keep us informed. And we covered that same topic in our Introduction to Medicare episode recently with Joanne Giardini Russell, because that is a stinger if you mess that up.
If you had Joanne on your podcast, then your people are absolutely getting the best information. But, Melissa, there's one other thing I want to talk about, because I know a lot of your listeners are women.
Yes.
So it's really important to understand health savings accounts are agnostic with respect to sex. They don't care whether you are a man or a woman. But there are some reasons that HSAs are probably more important for women. Women tend to have higher medical expenses. And we used to always joke when I was in the insurance industry, we love having single male guys. They don't get pregnant, they don't get sick, and when they get sick, they don't go to the doctor.
Last thing they do.
Exactly. So they're low claimants. Women tend to listen to their bodies, and when something's wrong, they know it, and they're going to the doctor more often. So that's one factor. But, women have two unique things medically that drive up their costs. One is they give birth, and two is they go through menopause. And those are two things that men don't do. So women are naturally, on average, going to have higher claims than men. So more expenses that need to be reimbursed somehow, why not reimburse them tax-free? The other issue that women have is, on average, they live about 2 years longer than men, which means at the end of their life, when medical expenses are highest, they're going to have 2 more years of medical expenses than the average man. So they need more money set aside for medical expenses in retirement. And as we've mentioned, the HSA is the only tax friction-free vehicle they can participate in during their working years, which means every dollar they put into an HSA is going to have greater spending power than the same dollar in either a traditional or a Roth 401k or IRA. So really good during their working years and really great for them at a time in life where they may have less income and fewer resources to have that extra money coming out tax-free to pay their medical expenses toward the end of their lives.
Well, what a powerful conversation. And that is some of the art of financial planning, is working with a professional that is able to have these discussions with you, talking about, in our family, we're really worried because there's an age gap perhaps between him and her. And we want to make sure the person who's likely to live the longest isn't in a bad place because of the medical costs of the first person, the older person, things like that. So there's so many different strategies, whether we talked about the early retirement funding with helping with premiums, or perhaps really the HSA becomes that pot for longevity protection where you live longer than you expected. And of course, going into that, we cover, it's really important to make sure you have the right beneficiary designation to your HSA, so that it could be something that's convertible from you to your spouse through a beneficiary designation if you pass away first. So,
Melissa, twice you've mentioned financial planners. And I just want to say something quickly about financial planners. We all have primary care physicians. We all have our favorite mechanic for our car. But so few people rely on a financial or retirement professional to help guide them through their finances while they're working and in retirement. And about 10 years ago, I was interviewing a number of firms. I wanted some retirement professional advice. And I can recall going to one of them and he's saying, how much do you have in your tax-deferred IRA? I'm like, blah, blah, blah. Oh, that's great. How much in your Roth? Blah, 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 blah. How much in your HSA? Well, at that point, I had about $75,000. I said, $75,000. He's like, oh, yeah, whatever. What was the Roth again?
And he's not going to manage it, right? Typically there's not an advisor managing that account.
Yes. So the lesson there is, if you're looking for a financial or retirement advisor and they don't understand the power of health savings accounts, keep looking. And Melissa's absolutely right. In a lot of cases, they're not going to be investing that money. So there's no revenue stream in it for them. But if they don't understand what an HSA is and what it can do for you, then I would argue they can't give you the best advice that you could get for planning for retirement. So really think hard. The next people I interviewed, I told them, oh my God, that's great.
It is a great
That's
number.
one of the 5 stools of our retirement planning, and nobody else understands this. And boy, you're so far ahead of people. There, I knew I'd found the right people because they are looking at everything in retirement, and that was so important to me.
Yeah, I mean, I'm sitting there thinking, if you're not advising on the HSA, I want to be talking to you or my, successors here at the firm. I want them to be talking to you and saying, oh gosh, I'm so glad Melissa recommended that, versus like thinking, oh, I'm kicking myself because we don't have that HSA. So, and you really need someone who's going to be objectively thinking in your best interest, because all the fruits and rewards come back to everybody involved when you have somebody with that kind of naturally aligned relationship.
Exactly.
Well, Bill, we will make sure to have links to resources in the show notes, including your contact details. Thank you so much for joining us today.
Melissa, thank you. The pleasure's been all mine. And listeners, feel free to follow me on LinkedIn. As Melissa said, I publish 2 or 3 original articles a week on health savings accounts, maybe more than you want, but pick and choose.
Okay.
Pick and choose. We just look at them from a lot of different angles, and it's all free information, and it's designed to help you.
I love it. Thank you. Thank you for listening to the Women's Money Wisdom Podcast. If you found value in this episode, the best way you can support the podcast is to forward an episode to a friend or leave a review. Go to pearlplan.com and the podcast link to get all the resources and links mentioned.